Assalamualaikum to sir. We are from Group 3. Will present about financial proposal on the key investment factor, investment technique, and source of financing. Before we start, let me introduce myself. My name is Hanifa binti Muhammad Fadila. I'm from the SM5A. I'm the leader in this group. To begin our presentation, I pass to first presenter.
Hello, my name is Amirul Ravis. I'm from the SM5A. I'm going to present about the introduction of capital investment. Capital investment is the amount invested in a company to enhance business objective. It can be made by company executive in their business by purchasing the company's long-term securities or assets. The acquisition of physical assets by the company for use in advancing its long-term business goals and objectives. Capital investment comes from a variety of sources such as financial institutions, venture capitalists, and among others. Capital investment is to finance the long-term growth of the company, and it's also to increase operating capacity, capture a larger market share, and generate more revenue. That's all from me. Thank you.
So we have the cost of capital is the minimum return required to justify a capital budget project such as construction of a new plant calculated by a company. The term of cost of capital is used by analysts by an investor interchangeable but is always referred to a calculation of whether the expense of a purpose choice can be justified. Investor may also use the phrase to describe a comparison of potential return on investment to its cost and risk. Many businesses use a combination of loans and equity to fund business expansion. The overall cost of capital for such business is calculated using the weighted average cost of all capital sources. This is known as the weighted average cost of capital, WACC. There are 5 costs of capital, so we are going to explain that. Number 1 is the cost of debt, is the cost of raising funds through debt, such as debentures or financial institution loan. It is simple to calculate the cost of debt, but it is made up to the interest rate paid. In practice, the risks are free rate plus a risk premium, which include a project rate of default and the amount of recovery in the event of default can be used to be a model the company interest rate. The interest rate is also exorbitant for business with similar risk or credit rating. The price of eternity is represent the leader expected rate of return. The debt is linked to an interest rate. Number 2 is we have cost of preference. Preference shareholder expect a certain rate of return. Preference shares are frequently cumulative, which means that preference dividends accumulate with until they are paid. There are 2 types preference shares are in redeemable preferred security and redeemable preference share. Number 3 is cost of equity capital. It can be defined as the lowest rate of return a company must achieve on the equity finance portion of investment project in order to maintain the stock market price constant. The defined approach of cost of equity capital refer to the discount rate that link the present value of all expected future dividends per share with the net profit of sale or the current market price of share. Calculating the cost of equity is more difficult because equity does not pay a fixed return to its owner. The cost of equity, like the cost of debt, is broadly defined as the risk with the weak anticipated return required by investor, where the return is large unknown. The cost of equity is calculated by comparing the investment to other investment with similar risk profile in order to estimate the market cost of equity. The cost of equity capital is computed using the previous mentioned required rate of return. There are two methodologies for calculating the cost of equity. Number one is dividend approach. The cost of capital is determined by the required rate of return in terms of future dividends to be paid on the share. As a result, the cost of equity capital is defined as discount rate that equals the present value of all expected future dividends per share dividend by the net proceed of the share sale. Number two is capital asset pricing model approach. CAPM describes security price behavior and provide a mechanism for investors to involve the impact of proposed security investment on their total portfolio risk and return. It was created in the mid-1916 based on numerous assumptions about market and investor behavior. The capital asset pricing model is a set of equilibrium conditions that allow us to forecast an asset return given its level of systematic or not decipherable risk. Number four is cost of retained earning. The cost of retained earning can be defined as opportunity cost incurred by equity shareholder in the form of foregone and or withheld dividends. Because retained earning, eternal equity are component of equity, their cost is the same as the cost of equity. Dividends are a component of equity holder return on capital, and they influence the cost of capital through that process. The cost of retained earning can be defined as opportunity cost dividends foregone or withheld from equity owner. For the last is weak average cost of capital. The weak average cost of capital WACC is used in finance to calculate a company or cost of capital. The value of company equity plus the cost of its bids for a company with no outstanding warrants or option. This is the same as the company market capitalization. The cost of debt should be updated on regular basis as the cost of debt change due to interest rate change. The term equity in the debt to equity ratio refer the market value of all equity, not the shareholder equity on the balance sheet. To determine the firm's weak cost of capital, first compute the cost of the individual funding source, cost of debt, cost of preference capital, and cost of equity capital like I explained this before. For the chapter 2 is capital investment. The purchase of physical asset by a company for the purpose of achieving its long-term business goals and objective is referred to as capital investment. Real estate, manufacturing, builder, and machine are examples of capital investment. Capital investment is a broad term is two distinct definitions. An individual, a venture capital organization, or a financial institution can make a capital investment in a company. The fund can be provided as a loan or as a portion of future profit. In this context, capital refers to a money. A corporation management may also make capital investment in the company. They invest in long-term assets such as equipment to help the company run more efficiently or grow faster. Capital refers to tangible asset in this context. In either case, money for capital investment must come from somewhere. A new company may seek funding for a variety of sources, such as venture capital firms, angel investors, and established financial institution. There is no such thing as a minimum or maximum amount that can be invested. It can range from $1,000 from a startup to hundreds of millions of dollars for large projects undertaken by companies in capital-intensive industries such as mining, utilities, and infrastructure. For the chapter 3 is operating cash flow. The amount of money generated by a company regular operating activity over a given time period is referred to as operating cash flow, OCF. OCF begins with net income from the bottom of the income statement at bank and not cash item, and adjust for change is in net working capital to calculate total cash credit or consumption in the period. While conducting financial analysis, operating cash flow should be used in conjunction with net income, free cash flow, FCF, and other variables to fully measurement a company performance, financial health. Chapter 4 is investment life. An investment is a purchase of an asset or object with the intent of generating income, appreciation. The term of appreciation refers to the increase in value on asset over time. When a person purchases something as an investment, the intention is not to consume it, but use it to build wealth in the future. Investing is done to generate income and increasing the value of an asset over time. An investment can be any machine that generates future income. Any activity undertaken in the hope of increasing future revenue may be regarded as an investment in general. When it comes featuring one education, an investment may not produce any return or may even lose value over time. This is primary distinction between saving and investing. Saving is the process of amassing money for future use with no risk, whereas investing is the act of leveraging money with the some risk or for a potential future benefit. There are two types of investment life. First is economic investment. Investment are linked to economic growth within a country or nation. Economic growth is typically the result of corporations and other entities implementing successful business investment strategies. Number 2 is investment vehicle. An investment bank provides a wide range of service to individual and organization, including several geared toward assisting individual and corporation in increase their wealth. That's all for me. Thank you, sir.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Aina Fiza binti Mak Yusof. I'm from the SM5A. I want to present about capital investment technique. Investment strategy refers to a set of guidelines intended to assist an individual investors in achieving their financial and investing objectives. This strategy directs an investor's decisions based on their objectives, risk tolerance, and future capital requirements. It ranges from conservatives who pursue a low-risk strategy with an emphasis on wealth protection to very aggressive investors who seek quick growth through capital appreciation. The investment strategy is important because it may assist investors in making a quick choice about the investment company want to make, and it can be goal-oriented. Here's the three techniques, which are payback period, net present value, and profitability index. The first technique is payback period. Payback period is an amount of time required to recoup an investment cost. In a simply, it refers to the time it takes for an investment to break even. People and business spend primarily for the purpose of receiving a return, which is why the payback period is important. It assesses how fast a company may recoup its original cost. Is the amount of time required for a project's original investment to be repaid. The lower the return of investment, the more appealing it is. Here's the advantages of payback period. The first one is simple to operate and understand. Second, quick solution and useful. And third one is useful in case of uncertainty. For the advantages of payback period are not all cash flows covered, not realistic and ignores profitability. The second technique is net present value or known as NPV. NPV is the difference between the current value of cash inflows and withdrawals over a period of time. The net present value is a calculation used in capital budgeting and investment strategy to determine the profitability of a proposed investment or project. The company worth will remain the same if the project achieves a return equal to the discount rate. The advantages of NPV are time value of money and decision making. The disadvantages of NPV are no guidelines to calculate, required rate of return and hidden costs. The last technique is profitability index. The profitability index, also known as the value investment ratio (VIR) or profit investment ratio (PIR), is an indicator that shows the relationship between a proposed project's expenses and benefits. It's computed as the ratio of the present value of future predicted cash flows to the initial cash outflow. A project with a higher profitability index will be viewed as more appealing. It measures how much value a project generates for every dollar invested. The advantages of profitability index: first, accept or reject a project. Second, accounts for it. For the advantages are ignoring sunk costs and estimating opportunity costs. That's all from me. Thank you.
Assalamualaikum, my name is Putri Riza Atira binti Muhammad Haris. I'm from DSM 5A. So today I would like to present about my part, which is sources of financing. Next is development financial institutions. The Malaysian government provided a substantial amount of cash for the establishment of the DFI in order to provide financial assistance to the maritime sector. They include bank industry and technology Malaysia, which has been providing funding to the technology, export and manufacturing sector for many years. Bank Bangunan and Infrastruktur Malaysia Berhad is another DFI that can provide the same advantages and significant role as BITM. As a banking organisation, the DFI serves as a means of establishing tighter links with the global community. DFI has provided maritime companies with cash in the form of shipbuilding and ship purchases loans, as well as fixed operational and revolving credit lines. So, for sources of financing, first is merchant banks. To fulfill increased funding requirements, the shipping industry use private or syndicated finance contract with some of the many main true possibilities like project financing, term financing, conventional finance arrangement, and Islamic financing structure are all common means of ship financing. HNWIS and multinational corporations are one of the clients of these firms, and international financing and underwriting are two of the more interesting operations. These include foreign direct investments, trade finance, and virtually limitless international transactional capacity. Letter of credit, issuance, overseas financial transfer, and more are common in merchant banks. Customers who use the bank's advising service and other products pay to fee the bank. Second is bond market. Fixed income market (FIM), debt market (FID), or credit markets is a collective name given to all trades and an issue of debt securities in Malaysia. The bond market is typically used by government to raise money, to repay debt, and to finance structural change. The bond market serves as a benchmark for many organizations when it comes to setting standards for their payable and cost of capital. In spite of the high coupon rate for bonds, the bond market is still considered to be a low cost of equity. And the third one is offshore borrowing. Some shipping businesses have turned to offshore borrowing to satisfy their current cash flow requirements, and offshore loans is one that is obtained by the borrower from a lender located outside of the country in which the borrower resides. When it comes to banking and finance, this word is used to describe disparities in external regulatory environments. So for offshore borrowing, there are external regulatories, which is first offshore customizations, setting up investments and deposit firms for individuals, high net worth company relocated to escape taxes, restrictions and other regulations. And second, debt financing services provided. Term financing is offered by offshore banks. Loans from banks that have a set interest rate and payback plan of predetermined amount. And third is loan syndicates. Various loans are involved in the process of issuing different loans. Fourth, bridging financings, temporary finance utilized by firms and other organizations to rescue the short-term position in arrangement financings. Fifth, project financings, loans backed by project cash flow as well as security or secondary collateral representing the project's rights and interest in its assets. And six, letter of credit. A letter from the bank guarantee that the buyer payments to the seller is received on schedule and in full. If the issuer is unable to pay back the loan, the bank responsible for the entire purchase price. Last is working capital financings. A company ongoing operation can be funded through working capital loans. A company's short-term operating needs are funded by working capital. The last one is government funds. As a general rule, government funding enters some kind of financial assistance for a project or businesses. Actions taken by the Malaysian government demonstrate its support from the promotion of the industry. Like the government has allocated a total of around 1.3 billion in transportation funds as venture capital for merchant boats. Income from shipping is exempt from all taxes. And the last one is payment is the primary mode of exchange in the shipping industry and the local economy. So that's all for me. Thank you.
So for the conclusion, all businesses and investment projects require capital to operate. The cost of project capital is the minimum expected rate of return that a project must offer to investors to attract money. In short, the cost of capital is the expected rate of return required by the market to commit capital to an investment. Thus, the cost of financial capital to a firm is the return received by the firm's investor, debt and equity holders from borrowing savings for use by the firm's portfolio of investment projects. Investment is essential to achieving goals. Investing means we have money, then we must do an analysis to invest that money and hope to get a return in the future. If the investment is carried out early, then we will get a lot of profit if it goes well. Otherwise, we will lose all the investment that need to start from the beginning. Also, we must set an investment plan to make the investment run smoothly. From that, we can know what we will face in the future, what risks we need to be overcome, the current economy and more. So, capital investment is considered a very important measure of economic health, and when businesses make capital investments, this means we are confident in the future and intend to grow the business by increasing existing productive capacity. That's all from me. Thank you.
That's all from us. Thank you for hear our presentation. Thank you, sir.